Today we're going to be talking about trading the stop hunts. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. Last few videos we've gone a bit more in depth into market making, stop hunting structures of the general market. Today we're going to go a little bit more in depth. I've received a huge amount of emails and questions and comments regarding the other videos talking about the stop hunting. I'm convinced that there's a reason why 99% of retail traders lose money, and today we're going to talk a bit about that. And we're also you're going to be able to go back and apply this to your own charts, especially if you follow the pound crosses. This has played out almost perfect to the template this week. And I'm going to explain a little bit more in depth about what I look for in terms of keeping myself out of the market and how things, as they open up, as London starts and Europe start to trade, what I look for with my overall general market structure and how that can help me prepare for either entering into the market or looking at what I would consider to be a low probability day and what types of ranges I'd be looking for. And then also on the days when we get our huge opportunities, how I will identify my strike zones in terms of when I want to enter the market and how I'll be able to predefine my risk and what I will look for in terms of an asymmetrical opportunity if it presents. So last few videos we've talked about the general market maker template with M and W type patterns. You can flip that and the other way, it would apply the other way, but generally speaking, the market during Asia will tend to create a consolidation phase. Now we've seen lots of Asia trading timeframes that have expanded their ranges and had great trading opportunities. One of the things with that is that generally speaking, when things are sort of stable or normal, we've had the Brexit type of information in the markets this week. But generally speaking, it's probably not as consistent. For the most part, we'll look to see and identify a consolidation phase into the New York close and into Asia that we can start to look at and say there's a 25 to maybe 50 pip range depending on the pairs. As I've mentioned in the other videos, I tend to follow the pound yen, euro yen, but I will look at other cross rate and major pairs as Asia's closing to see where they're at in relation to their Asia trading range. Now, I've had a lot of questions about the I-sessions indicator. I generally just have that set from the first hour of the day till the 8:45 candle, which roughly speaking is around 2 a.m. New York time, wherever you're at in the world. And I use that as my range before London opens up. So again, if your currency has an average daily range of, let's say with the pound yen, maybe let's just use 120 pips as a round number. And they've used 40 in here. What I then will extrapolate, first of all, is we talked about the structure. I want to know where I'm at in this phase of the trading structure. Now with the pound pairs, this would actually be going the other way, where we'd be, instead of this is an M, A, W type of trading scenario, referring to the A as the V stops, okay? And in the uptrend, we're looking at it as a W, V, V, M, because it starts off with the W, and as the market progresses, we get V stops, and then we'll end with an M pattern at some point, whether it's in a big trading range, midweek reversal that will somewhat end in an M pattern. Now these have been so evident this week in the British pound pairs. So what I'm going to talk about today, I'll just grab is some of the ways that I will look to help identify, once I know in terms of the structure, how I will look to identify how things open up in London as they come out of the box. So if I'm in an uptrend, the market's been, in terms of that general 3 to 5 day structure, we're seeing higher highs We're seeing the V stop rise, or the level one. I talked about don't counter trend a level one trade. They tend to move very quickly. But as London opens up and we've had trading, if the market has been trending up and I'm looking for these V stops to enter the market. Now, last video I talked about I'm preparing for a V drop of around the 50 pip marker, okay? So I want to see that market drop down to around the 50 pip level. So before I start my session, I go to the previous London, New York session, the previous day. We've got our previous day's high, we've got our previous day's low, but we've also had trades that have taken place in the last session. There will be traders that are in profit, or they were right. They'll have break-even stops. They'll have stop losses or gaps, profit gaps somewhere down here. And I will look in that 50 pip range as to where there are stops sitting that a V drop may come down and take out. So I want to know where my strike zone is. Strike zone, sorry about my markers. Okay, so if I know where, once I've got this range, as Europe's opening up, then what I'm looking for is a 3-drop push down to my strike zone. Now in that strike zone, which will match up somewhere over here with my stops, low, daily lows, whatever, I'm going to have some levels in here of probably 10 to 15 pips that once I see a 3-drop push out of the box, and this will usually happen in that first hour between 3 and 4 a.m. New York, roughly, thereabouts, give or take 15 minutes. And at this point, I will be looking for maybe a pin bar. Now, I use 15-minute charts, but I will go down to the 5-minute chart once I'm in this strike zone to try and get my entry with that 3-push pattern, maybe to around 10 pips. So we're looking at this as a stop hunt. We've come out of the bottom of the box or the middle of the box with a 3-push pattern down into that 50 pip range. This is critical. That 50 pips is enough of a push out of the box to clear stops of almost all retail traders. Very few traders will have stops in that 50 pip range. And generally speaking, they will try to clear the board. So in terms of how you approach the market, think about where is the money. We're going to have money at daily lows or at previous profitable trade levels and at daily highs, including the intraday high that's currently there. So once I'm in this strike zone and I'm able to take a position, I can usually identify a 12 to 15 pip stop loss, but now I also am targeting 50 to 100 or more pips back in the other direction. This is critical that we see 3 pushes out of the box. Now that's one example. That's the V drop or the A drop trades. Okay? Now, chances are we're probably only going to see 1 or 2 of those a week in a pair. Now this week we've seen a couple, but again with Brexit and a lot of the other information that's going on in the market, I think we've had lots of movement, lots of opportunities, but we've seen some textbook V drop and A drop trade setups. The euro pound was another one yesterday. Broke out of the box in the Europe London Open, created a hammer up top, a reverse hammer, and that market dropped 90 plus pips down. So one of the other things that I will look at is that when Asia has been trading, if we are, sorry, I'll use the other marker. If again we are in what we've defined as an WVVM type of market, an up market, and the market breaks out long, what I will be looking for now possibly are 3 pushes down or 3 pushes up to trap higher level longs and trap weaker lower level longs as well. And we'll see chop where even if you go long down here, you're only getting maybe 25 to 40 pips range of movement, or maybe more, but it's generally a consolidation type day that sort of goes back and forth. The longs may be able to stay profitable, but the higher level longs would get stopped out, and lower level longs will get stopped out eventually by the V stop. But my point with that is that when the market's in an uptrend and we're breaking out long, stop hunting high, or trapping volume into the market, then I know in the next day or two we're heading towards one of these V drop rise scenarios. After some big moves in the markets, the market makers need to accumulate more volume to generate the order flow that they need to accumulate before they can create this V drop rise. So what I'm trying to get at here is that you're not going to get that scenario every single day, but you are going to get it, especially when you see these consolidations. Now, the difference between a consolidation trade that pushes out of the market in an uptrend and traps volume in sort of almost a sideways market is that at a midweek reversal, what you'll tend to see is the market will run both sides a couple of times. It will run the top, run the bottom, consolidate, and then look at rolling over. So again, printing off your charts and going back and studying this will help. Now again, one of the other scenarios that we will see is a reversal day. And that's a little bit different than just seeing a push out of the box. What the reversal day will normally do is take out the previous day's high and trap volume up high before it returns into the daily range. And they sometimes will call this a half Batman type of pattern, but that's when you'll get opportunities, and they can happen in the long direction as well, that London will open up with a stop hunt tail at 3:45 New York time AM, 4 a.m. Around 4 a.m., 3 to 4 a.m. again New York time, and that market will tend, that candle itself will tend to be the high for the session, and we saw one of those this week as well. So that's a different scenario. A reversal day is not the same as just a push out of the box in the trending market. That is a reversal day. You will see a significant push out of the market and a pullback and a gradual fade back into the trading range that collapses pretty much right from the top of the market. Friday reversals, also something we've talked about, but again, that's where your overall structure in the market is important, where we have a level 1 trade, then we'll have a level 2 trade. When we get into a level 3, we'll have whipsawing on both sides with ending in a small M pattern, which will then typically break out of the box and roll over, and often they will move quite quickly to at least the downside, but often to the low of the week. And we've seen that a few weeks ago where markets have built up over 4 days. They've had 1, 2, 3 levels of rise, 3 days of rise, or 3 levels of drop, and then in a couple of hours wipe out the entire range of the week off the open of Europe or London. So hopefully you got some value from today's video, traders. Again, one of the best things that I use is that 25 to 50 pip rule. Once the market has come out of its trading range of Asia, now again, you want to pay particular attention to the range itself. So if you're hitting your ADR and Asia's only started to trade, then you possibly could end up in a range-bound day unless the market pulls to the low of the day or the high of the day. But that 50 pip rule, when I see a market push 50 pips out of the box with 3 pushes down, I'll be looking at where my strike zone is, and I'll be looking to enter the market going the other way. That is different than a market that has broken daily highs and failed and started to roll over. That's a reversal day. We're talking about markets that break out of the box and push down 50 pip levels. And again, each currency pair will be a little bit different. The pound, though, has quite a bit of push to it, and 50 pips is my general rule. But again, that will match up where my profit gaps and stop loss targets are at intraday lows, or previous day's lows, previous day's highs. So print off your charts, go through your charts, draw your levels, Pay particular attention to the time of day. People talk about the volume increasing and everything else. That's when the market makers go to work. They will try to validate technicals in those Asia boxes and in those breakouts. So it'll entice breakout traders, trend traders, moving average traders, all those other types of systems to generate signals. It will pull them into the market. You've probably been up 20, 30 pips before, and then boom, 10 minutes later, you're almost back to break even, and you watch the market march back the other way, screaming away. Often these will be vector candles, which will take off quite strongly. And when you're in the right direction off of these trades, it's almost instantly that the trade is moving in the direction that you're after. So if you haven't done so, go to my homepage, get my 7-step daily routine for high performance traders. Ritualize your daily routines. Get in the habit of accelerating your learning, bulletproofing your mindset. If you're getting knocked down and you're taking losses, figure out how you can do it better. Don't blow yourself up. Keep doing the little things day after day after day that are going to help you improve, that are going to help you become a master of your skill to build confidence, discipline, and a winning mindset to master the markets. You can see that on some of these trades, they will offer significant reward to risk opportunities. These trades will happen often in the first hour to 2 hours of the market. After that, I come back, I leave the screen, I'll come back for the US session, and I will look for the same sort of opportunities depending how the London market is played out. So keep getting better, traders. Stay disciplined. Enjoy the weekend. Get out and get some sun, and may the markets go with you. Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.